All right. So everyone in the class, very good afternoon. Everyone, welcome to this amazing session. In this video, we're gonna discuss the entire chapter of International Financial Management of CA Final AFM, that too in full English language. This revision video will have discussion on the concepts, understanding the concept as well as solving at least one question of each concept, each type, so that whatever you learn, you are also able to learn whatever concepts you learn, you are able to apply those concepts, apply those learnings to the practical questions, right? So great everyone, I hope you all are doing great. The exam preparations are going great because it should go great, right? So let me first of all share certain things with you before we get started. So guys, in this video I will make use of two notes: OutNotes, the concepts notes, and the OutScanner, which is question bank. Both of these notes are being used in all our batches. The same notes are being used for the purpose of this revision, right? So one is OutNotes. Let me show that to you, which is this particular thing. Which has all the concepts being taught to you in a very timeline driven manner, unique manner, in by way of tables, diagrams, charts, graphs, which make your learning very easy, right? The second notes I will refer to is the OutScanner, which is nothing but the question bank. Okay, so this question bank, people, has compilation of all the questions from RTPs, MTPs, exam paper, study material, and everything else which is relevant for you. In fact, with every question in the OutScanner, there is a QR code attached to it. If you observe, if you scan this QR code, you'll be able to watch the video solution of this particular question as many times whenever you want, so that any student facing any struggle in a particular question, you scan the QR code and you have the solution. That simple is the thing. So OutNotes, OutScanner, completely comprehensive. Sir, the link of these two notes, the soft copy is freely available to the students. Link is there in the description. If the hard copy option is available to buy, the link for buying these two notes is also there in the description. Perfect. Along with that, one very important thing, sir, I am attaching the link of the playlist which has coverage such revision videos even on the other chapters. For example, we are done with portfolio, forex, derivative, interest rate, risk management. We have plans to come up with such other chapters like fixed income securities, which is security valuation, mergers, acquisition, mutual fund, advanced capital budgeting, and so on. Yes, so I hope people that this is all set. So now we get started. Before we get started, I have a request to make to you all. The request is really simple. We are already done with the lecture of forex, which was for around 7 hours. In that lecture, we missed to do primarily one topic. There's a small topic as well, but 1 to 2 small topics. One small topic and one relatively bigger topic we missed to do in that video because the video got really extended. So I would request all of you that you'll have to please manage it a bit. We will first cover what we left in the forex and then come to international financial management. Those who want to specifically watch international financial management can take the video forward. Let me guide you. In our OutNotes, both of these topics are merged in a single chapter called as Foreign Exchange and International Financial Management. That is also the case in OutScanner, correct? However, sir, exactly which part of this entire chapter is International Financial Management, that if I have to tell you, so the last category, the last section of Forex chapter in the OutNotes is important residual topic. In this section, we have foreign currency account, we have foreign currency investment borrowing. These two topics specifically belong to Forex chapter, right? Rest of the topics like international cash management, international capital budgeting, adjusted present value and issue of ADR, GDR and IDR. These 4 topics belong to advanced capital budgeting. In this video, first we will complete the 2 pending topics of this Forex this and this of forex, and then we continue with international financial management. Yes. So sir, very quickly this particular thing, foreign currency account. So this particular thing everyone, so I hope you, those who come here to watch this video has first watched the forex video or has the knowledge of forex to be able to continue in this video, right? Because this video involves conversion from one currency to another, bid, ask, forward, spot, multiple things. I mean, you need the entire knowledge of forex to be able to watch this video. Sir, foreign currency account, when we talk about it, is actually not a question of finance, it is actually a question of accounting. Meaning to say, sir, in this concept, in this question, we learn to create ledgers. We learn to create accounting. When something I receive, let me show it as inflow. When something goes out, let me show it as outflow. Right? Sir, what exactly are the accounts maintained? Let me explain to you. Sir, have you seen your bank statement? Have you seen anyone's bank statement? Yes, obviously. That is your or anyone's account maintained with, for example, HDFC Bank. So in the bank statement, do you observe whatever you transaction make with the bank, right? All those are recorded in the bank statement. When if you have your bank balance, if you have a bank balance with them, that is shown as a credit balance. Credit balance shows, credit balance reflects your amount with them, correct? Similarly, when you withdraw any amount, that amount is being debited. So very similarly, there is this bank called as SBI, right? It has a bank with the Swiss bank in Switzerland in their currency Swiss franc. Are you understanding what's happening? SBI in the moment is the customer. SBI for now is the customer of this bank called as Swiss bank. So in the Swiss bank, SBI has a bank account. Whatever Swiss franc comes in is credited to this bank account. Whatever Swiss franc goes out is debited to this bank account. So we will not learn to record SBI's rupee transaction. That is not what here for. We are here to record the Swiss franc transaction done by SBI, right, from this particular account which is there with the Swiss bank. Are you understanding? We have to record basically we have to create two different ledgers, two different statements. One is called as exchange position, another is called as nostro account or cash position. Cash position or nostro account. This particular account records only cash transaction, which means only spot market transaction where the actual delivery and the actual buying selling happens. Unlike this is the exchange position where we record spot as well as a derivative market transaction. Sir, even if you enter into a forward contract, that is being recorded here. That's not recorded here. You enter into a spot market transaction, recorded at both the place. But if you enter into a forward buying or selling, something for which today only a contract has to happen or something for which the inflow or outflow will happen on a later date, all such transactions are recorded only here and not here. Are you understanding? That simple thing you have to do. We have a practical question on this. Let's go to that practical question and you will realize that. Let's go to that practical question. The question is really easy. The point is only to understand the transactions given in that question. So we're gonna do question number 64 of OutScanner, the question from study material and a repeatedly asked question. You as a dealer have following position in Swiss franc. In terms of Swiss franc, on 31st October, we have a position. Balance in nostro account, credit overbought position. Sir, in the nostro account, I have already my money deposit with them, 1 lakh Swiss franc. And in the exchange position means the account where both a spot and forward transactions are recorded. In that, it shows I have bought 50. Either I would have actually bought 50 or I would have entered into a contract to buy 50. Both are included in this 50. Fine. So how do we create the thing? First we create a nostro account, then we create an exchange position. Always remember this sequence. Sir, why do we have to remember this sequence? I will tell you later. Nostro is first, exchange position is then you create. Sir, after and in observe, Sir, the format is really easy. Credit, debit. Here it is bought and sold, right? There's a difference. Credit is this side and bought is this side. There's a difference. Sir, for example, sir, balance in nostro account credit. So we say opening balance credit 1 lakh. Here opening balance is 50,000. Now let's record these transactions one by one. Let me show you first of all 2 to 3 easiest transaction. The first easy transaction is sold forward telegraphic transfer. When you sell to someone under forward contract, how many Swiss franc? 60,000. Has the Swiss franc gone out of you yet? No. Has the delivery happened? No. Will it be recorded in cash position? No. But will it be recorded in exchange? Yes. Please observe 60,000 in the sold side will be recorded. Such a basic thing. Next, forward purchase contract cancelled. Sir, for 30,000 rupee you had once purchased forward. Now that is being cancelled. So when you purchased something, do you people agree that it would have been shown in the bought side? But now, when that purchase contract has been cancelled, I need to nullify its effect, and what I'll do? I will, everyone in the class, show it in the sold side to nullify the effect of the bought which was previously given in the ledger. Right? That was again easy. Sir, remitted by telegraphic transfer. This is actual remittance. This is actually selling in the spot market is something whose effect will be there in the both the accounts. I have my Swiss franc there in the bank, 1 lakh Swiss franc. Out of that 1 lakh, I sold in the spot market to someone 75,000 Swiss franc. So that is remitted by telegraphic transfer 75 gone, and the same amount is also recorded in the sold side. Are you understanding a spot market transaction getting recorded in both the accounts? The last two transaction, purchased bill on Zurich. Actually, the struggle with this question is not anything like any super rocket science concept. No, it is inability to understand what the transaction given to us mean. Sir, purchased bill on Zurich, like what they want to say is the bill of exchange, meaning to say I am SBI, you are my bank, Swiss bank. I have purchased a bill of exchange for 80,000, right? Now, do you agree me as a bank, when I purchase a bill of exchange, can you recollect the concepts of discounting a bill of exchange? When I purchase a bill of exchange, do I get the amount from the debtor immediately? No. When do I get the amount? Today, my bill gets discounted. A customer discounts the bill from me, but do I get the amount today? No. Imagine that 80,000 rupee, 80,000 Swiss franc I will receive, for example, after 30 days, against which the discounted amount, me as an SBI, the discounted amount in rupee terms I have paid today only. I had my export customer came to me to discount a bill. I have given to him rupee today, but the amount of Swiss franc will come to me on a later date. Sir, I am not recording rupee transactions, I am recording Swiss franc transactions. And accordingly, can I say 80,000 should be recorded in the bought side, not in the cash position, but in the exchange position. 80,000 purchased bill on Zurich. Very similarly, draft on Zurich cancelled, right? Sir, me as a bank, me as an SBI, for a customer I issued a draft. What does it mean? Issuing a draft means the customer has received a piece of paper. That piece of paper gives the customer or anyone the right to withdraw Swiss franc. So when I gave a draft of 30,000 to my customer might have paid me rupee. He paid me rupee, against which I gave him 30,000 Swiss franc draft. Customer can give this draft to anyone. Suppose it has given to a college. College can come to me, show me the draft which is issued by me only, and take from me 30,000 Swiss franc. That is how the draft works. When the draft was issued, Please understand, when the draft was issued, do you people agree? At the time of issuing the draft, I knew that I have received the rupee against which I'll have to pay the Swiss franc on a future date. I must have showed that in the exchange position in the sold side, because that outflow had to happen, right? Cash position would not have been affected, but exchange position would have been. Now, when that draft is cancelled, I will need to nullify the effect of it. When 30,000 was supposed to go out, now it will not, because the draft is cancelled, and accordingly I'll have to nullify the effect. I'll have to now show it as inflow. The objective here was to be able to explain to you how do you record the transaction. The next part of the question is really easy, which says that after all these transactions happening, we want to maintain a credit balance of 30,000 Swiss franc in nostro and 10,000 Swiss franc in overbought. How will you do it? So I first of all calculate the at present closing balance. 1 lakh credit, 75 debit. So 25,000 of credit balance. Look at the presentation, we will say credit balance carried down. Do you remember the accounting ledger? Credit balance gets carried down in the debit side and then again gets brought down in the credit side. So I have 25,000 credit balance and here I have 5,000 oversold balance. 25 is to be made 30 and 5 is to be made 10. It is oversold right now, it has to be made overbought 10. Sir, please remember, always you should do the adjustment of cash position nostro account in the spot market, right? Because the spot market will affect both the transactions, both the accounts. Then we will figure out that after balancing nostro, what is the status of exchange position, and then adjustment or the transaction to maintain the balance of exchange position will be in the forward account, will be in the forward contract. Because again, if I do a spot market transaction, it will disturb the balance of nostro, right? Is of no use. So what I'll do, I'll first of all do the nostro adjustment using spot account. I am already 25 credit. I will buy in the spot market 5,000 Swiss franc, get credited in my bank account with the Swiss bank. I'll have a 30,000 closing balance. After this transaction, what will be the effect on the exchange position? So I was oversold 5. Here is the oversold balance. When I buy spot, it becomes 0. Agreed. So what is the next step? I need to make it 10,000 overbought. So go to the forward market, buy 10,000 overbought and the balance carried down is 10,000 overbought. That's how. These are the transactions needed to maintain the balance as the question wanted. Question 54 gets done. I hope I could convey. Next concept, really brilliant, really interesting, will make your question solving very easy if you pay attention to what I explain, right? Please everyone in the class, please pay attention. Sir, foreign currency borrowing investment. You are an Indian. If you want to invest in India, life is easy. Go to the stock market, invest. Go to the commodity market, invest. You are an Indian, you want to invest in US. When you want to invest there, you need dollar. You need dollar, not rupee. In that case, what do you do is the point. You have to go to the forex market. First of all, do you realize that? Obviously, yes. Correct. So, timeline imagination that we have done in the entire forex chapter continue to be there. Imagine at 0 point when I stand, I have rupee in hand. Right? I mean, please understand the chart that you understand, that you learn here. Beyond this chart will not be any question. Will not be any question. Any question will be applicability of the simple chart that you see on the screen. I have rupee with me. I have two choices. Either I can invest in India this amount of rupee. Whatever is the rupee rate of return in India, it is I will earn, and I can redeem finally the rupee amount. Correct? Fine. Sir, since I am an Indian entity, I would want my final inflow to be in my home currency, which is rupee. So please make sure any question of investment borrowing, similar to the other concepts that we have learnt in forex, the final inflow outflow should be in your home currency. If you are US person, home currency is dollar, and so on. Correct? Fine. Another option is to invest in US. But if you want to invest in US, what is the thought process? Sir, whatever rupee you have today, you sell it. Is it a common sense that, sir, at 0 point when you sell it, it will be using a spot rate as 0? So when you sell rupee, you receive dollar. You have now dollar in hand, correct? When you receive this dollar, now you can invest it in the US at whatever is the US rate of return and redeem dollars only. So you had rupee, you converted yourself to dollar, sold, invested this dollar to redeem dollar, and now you know that your home currency is rupee, so you would want to convert this dollar amount back to rupee amount. So whatever is the spot rate or forward rate on that day, you sell these dollars and ultimately receive rupee. So when you have rupee, you can directly invest and redeem rupee, option 1. You can sell rupee, receive dollar, invest dollar, redeem dollar, sell dollar and receive rupee, option 2. Of the two options, whatever is better, do that. Whatever leads to higher inflow, follow that thing. That simple is the question of foreign currency investment. Sir, I want to create one more possibility for you people in this. First, sir, imagine, is it possible that, sir, I am an Indian company, my home currency is rupee, but examiners say that even if your home currency is rupee, you have excess fund available with you in terms of dollar. The starting point may not become this, the starting point in that question may become this because you have the availability of dollars with you. In that case, what do you do? So the blue circle represents where can the question start from. Sir, if you have dollar, you again have two choices. Invest in dollar as it is, redeem dollar. Whatever dollar you have redeemed, sell it off using spot or forward rate and receive the home currency rupee amount, that is option 1. Or option 2 was invest in India. So if I have dollar and I want to invest in India, what do? I will sell these dollars. Receive rupee against those dollars at the spot rate, and received rupee amount I will invest people in the class at the rupee rate of return and ultimately redeem rupee. Meaning to say, starting point is this or this, the end point has to be this. There are two ways. One is home currency investment, another is foreign currency investment. If the starting point is this, one option will be this and another option will be this. However, if the starting point is this, one option will be this and another option will be this. That simple has become the entire concept. I hope I could explain it to you. End point has to be this. Please always remember, whenever you do any transaction of buying, selling one currency to another, spot rate will be used as 0. When you again do the buying, selling at the end, it will either be the spot rate of T point ST or the forward rate. So let's once solve the practical question related to foreign currency investment, then we'll solve a practical question related to foreign currency borrowing, and that's going to give us the needed confidence. Sir, the first question that we're going to solve is question number 70 in the class right now. Super ultra fast, please look at this question. ICAI, Indian MNC, is executing a plant in Sri Lanka. Fine. It has raised rupee 400 billion. Half of the amount will be required after 6 months. It is looking an opportunity to invest this amount. So on 1st April, half of 400 billion, which is 200 billion, is extra with me. I am looking for an opportunity to invest for a period of 6 months, considering two options. One is I can invest in Japan, another is US. Sir, if nothing is okay, it is specified that I am an Indian company, my home currency is rupee. Nature of investment here, it is index fund, here it is treasury bill, which means stock market versus bond market. Dividend, when I invest in Japan, in billion terms I will earn 25 billion yen. Income from stock lending. There is a type of income related to the share. Sir, income from stock lending is 11.9276 billion yen. Discount on initial investment at the end. Understand this line. Whatever you had invested initially, on that initial amount, the closing value of the investment is at 2% discount. When you invested 100, right now it is left as only 98 in the market. So I have been given detail of the closing value of my investment. Exchange rate, 1st April, it is JPY INR 1.58. Exchange rate after 6 months, 30th September, JPY INR 1.57. Similarly, when you invest in USD, which is in the treasury bill, the interest rate you will earn as 5% per annum. Rate is USD INR 0.04 and 0.013. Sir, are these ISO codes possible? Let's observe 0.014 can be what? It will nothing be but dollar per rupee. Can $1 have only 0.014 rupee? No, but 1 rupee can have so less dollars. So which means even if it looks like ISO code, you will not have to interpret it like ISO code, as I explained the same concept even in the forex. Sir, so accordingly the interpretation here will be yen per rupee, right? Let me check if I have the handmade chart of this question. Most probably there will not be. The reason is really simple. The reason is really simple because the timeline is very easy for this question. It can be imagined in the concepts, I mean in the wait. 70 question. Okay. We don't have a timeline obviously because it can obviously be imagined with the help of OutNotes. So let's get started. Sir, I am an Indian company. I have excess fund available in rupee. So I have rupee 200. Option 1. Sell this rupee to buy yen. Invest yen and redeem yen. And sell this yen to receive back rupee. That is option 1. And then do the same thing with the help of dollar. So let's super quick solve it. Sir, I have 200 billion rupee. The rate is also of rupee. So 200 multiplied by 1.57 give me 314. 1.58 give me 316 as the amount invested in terms of yen. Today I invest 316. That is at 2% discount at the end. So 316 minus 2% give me 309. 316 minus 2% give me 309.68 as the amount of my closing investment. But on that I have received two more things. 25 rupee of dividend and 25 billion yen of dividend income plus 11.9276 billion of other income related to stock lending. So 346.6076 is the closing amount of yen, is the value of the portfolio, right? The value of my investment. Sir, that closing amount after 6 months on 30th September when converted back to rupee, how much it turns out to be? Sir, I have amount in yen, rate of rupee has been given. I'll have to divide it by 1.57 to get 220.7692 on a rounded off basis as the inflow after 6 months in rupee terms. Fine, cool. Now let's check, rather than that, if you invest in US, then what will be the case? Sir, I have 200 rupee multiplied by 200 billion multiplied by 0.014 give me 2.8 billion as invested in USD, which will earn me 5% of the entire year for a period of 6 months. How much will it be? One might think that, sir, we should do, since dates have been given, we should do date-wise calculation, which is 100% logical, but unfortunately institute considered this 6 month as the base, right, and made month-wise calculation, right? To you will not have to worry a lot. Try to remember that, okay, this question has month-wise calculation. If you are able to remember it till the exam, well and good. Not able to remember it, you will do a day-wise calculation. Irrespective, write a note in the towards the end of the question, because these ambiguities we cannot help with. Sir, institute has done these ambiguities in various questions. We can't control and we can't remember it actually. Done. So taking you back, 2.8 is the investment. On this amount, when you earn 5% for 6 months, so 0.05 into 6 divided by 12 plus 1 into the amount of 2.8 give me $2.87 billion is the amount I will redeem. Where every rupee now is $0.013, so $0.013 gives me 220.7692, the same amount of rupee which gets redeemed. So whether you invest in Japan or US, the amount being redeemed is the same. Then what one will you prefer? Sir, if the returns are same, then risk is to be considered. This is a stock market, this is bond market. So bond market is better, which is why we say treasury bill is suggested, and that solves question number 70. Correct? Fine. Sir, there are various other questions on investment. One question I would want you to do in the class, not entirely but trying to give you a sense of it, is question number 76. A brilliant and very comprehensive question. If you look at the timeline presentation of this question, you will observe that such a tough question has been really simplified to this small timeline. It looks complicated initially, but if you look at it, you will observe that the entire question has been simplified. Yes, so please look at it. What it says, I'm not going to make you people solve the entire question, but also only try to tell you how do you approach this question. Not entirely we will solve. Your bank's London office has surplus fund to the extent of USD 5 lakh. Are you observing what is happening? Sir, I am a company. I have my home currency is pound because my office is in London. But my excess availability of fund is not in pound, is in dollars. Can you observe the difference? Which means the starting point this time will be $5 lakh and not pounds. But the end point will have to be my home currency, which is pound. So directly explaining the question, they say for a period of 3 months, you can invest the available dollar either in London, which means your home country, or you can invest is it in dollars, which is US, in which the funds is available, or you can invest it in Frankfurt, which relates to euro. The exchange rate of dollar per pound spot and forward is given, and euro per pound spot and forwards are given. They are saying where should we make the investment. Net gain we have to find out. Sir, what do they mean by net gain in terms of pound? So in terms of pound you have to do that is fine, but in terms of nearest pound, which means round off to the nearest pound, don't take it to the decimals. But what do you mean by the net gain? Let me explain. They say this 5 lakh USD which is available, it has a cost to the bank of 4 lakh. I am a bank, I have 5 lakhs extra available, which I can invest anywhere, but there must be some source where I have got this amount. Wherever I have got this amount from, I have to pay 4% interest on a per annum basis. So on the timeline, if you imagine, I have a 5 lakh rupee already borrowed from somewhere, which is why they are available. So I try to invest it into different currencies. Against the borrowing, I will have to at some point repay along with 4% per annum interest. Yes. Now, whatever amount you like, whichever currency you invest your amount in, ultimately you will redeem those amounts. After redeeming the amounts, if you deduct the outflow of that 5 lakh USD to be paid back, then whatever is left is the net gain, is what the question has asked us in this particular case. Please observe there is a difference. Previous question that we had done, we did not have any borrowing hidden in the investment. In this investment question, we also have an amount of borrowing which is actually being invested. Correct? So when you redeem the amount, in the previous case, only the final inflow in my home currency pound did matter to me. Right? For example, linking this question with the previous question, it's like what I'm needed to calculate in the previous question was the only final amount of inflow in my home currency. In this question, from this final amount, you will have to also deduct the amount of repayment against the borrowing of 5 lakh and find only the net gain. Could I please make you people understand the question? And try to differentiate this one with the previous one. The timeline imagination really make it easy. Now not doing the calculation, only trying to give you the flow of the solution. I have 5 lakh dollars. Assuming they are being borrowed with a 4% per annum rate of interest, after 3 months I will have to repay 5 lakh $5,000. The students who are conceptually clear are always able to understand that when you have borrowed something 5 lakh, it is available to you. To be able to invest this dollar into euro or pound or any other currency, you will have to sell those dollars. 5 lakh dollar when you sell in the dollar, if you want to invest in dollar, don't sell, invest as it is. If you want to invest it in pound, so sell dollars at the spot rate, buy pound and invest. I mean receive pound and invest. If you want to invest in euro, sell at a spot rate, receive euro and invest. Respective investment when you make at respective rate in those countries, you redeem an amount in respective currency. Fine sir, now common sense. I have 5 lakh 5,000 of outflow to be paid. Some amount of dollar outflow is to be met, is to be paid. After redemption, I have an inflow of dollar. Don't look at the numbers, look at the flow of the solution. There is a possibility that only after listening to me, you may not be very comfortable. But after listening to me, when you solve the question at your own, you will be 100% comfortable. Sir, when you invest in dollar and when you redeem in dollar, there is a dollar inflow available with you. From that available inflow, you have to make the payment of dollar outflow, and the difference is the dollar amount left with you. The net gain, but this is in dollars. On the day of expiry, I mean to say after 3 months, I'll have to convert that available dollar, gain of dollar into the pound using whatever is the spot rate that will be gained to me in pound terms. Yes. Similarly, sir, I have to, when I invested in pound, my final inflow of redemption is also in pound, which means these many pounds are available to me. But I have to find out the net gain. Now understand what we're gonna do. Sir, we know that I have to make an outflow of 5 lakh $5,000. Now those again who have the basics clear will know that if you have to make an outflow of dollar, you will have to buy the dollar. See, you should be able to figure out whether you are buying something or selling something so that you know whether the bid or the ask rate will be used. Sir, to be able to make the payment of 5 lakh $5,000 against my borrowing, if I need to make this repayment, I'll need to buy them. Using forward, if you buy dollar, you will figure out how many pounds you will have to pay from your pocket to buy those dollars. Out here are the available pounds. From that, you will have to make the payment of these pounds to buy dollars, and difference pounds as your net gain, which is what the examiner has asked. And this is the flow of the question, and similarly, investment in the third currency will happen. So this timeline driven presentation make this lengthy solution really comfortable. The question number 76, about which I just wanted to give you a sense only, right? After 76th question, in which we learnt about different kind of investment situation, now let me tell you about the borrowing situation. Yes, borrowing situation. Just give me a minute, let me have water, then I tell you. Okay, give me a minute. Yes, boss. So come on. Borrowing in foreign currency. So what happens? So this time the thought process has to be different. Sir, what do you mean? The most important line I'm saying. Sir, when I have to make an investment, the mindset is availability mindset. That funds are available. What do? Either I invest it or I sell it. If I sell it, then another currency become available. Then I need to invest it. In this case, borrowing, it is not the something is available, rather something is needed. For example, I'm an Indian company. One possibility is that I need rupee. So if you need rupee, option one is borrow from India only and repay to that Indian bank. Life is sorted. If you want to borrow in foreign currency, then what do? Sir, please imagine, if you need rupee, you will have to buy rupee. The thought process is, if you need rupee, you will have to buy rupee, and to be able to buy the rupee, you should be able to pay that foreign currency dollar. So now you'll be able to know that to be able to buy this much rupee which I need, I will have to pay these many dollars. And those dollars that you know now is to be paid, you will need to borrow them. And when you borrow, you'll be able to know how much dollar you will need to repay. So could you observe, at 0 point, ultimately if I need rupee, I can directly borrow rupee and repay. Or if I need rupee, rather than borrowing, I can buy them. But to be able to buy, I need to pay dollar, which is why I'll have to borrow in dollars now, and this is why it is a foreign currency borrowing. When you borrow dollar, you will need to repay dollar, and to be able to repay dollar, you will need to buy dollar now. Are you understanding? You need to now repay the dollar. You will need to buy dollar, and to be able to buy the dollar, you will have to pay the rupee, which is ultimately your home currency rupee outflow. So one is rupee outflow when you pay to the Indian bank directly, another is rupee outflow when you have to pay to the foreign bank in dollars, but you'll have to buy the dollar to pay ultimately rupee. Home currency is very important. In home currency, whichever option leads to a lower outflow, that is a better option. Sir, which means the starting point generally will be this. Can this also be the starting point? Yes. Let me prepare you even for this scenario. This time imagine that you need dollar, right? So option one, starting point of the question is this: even if I'm an Indian company, I need some dollars to do business. Option one, if you need a dollar, borrow dollar directly. You will know how much dollar to repay. Buy those dollars to be repaid, and to buy the dollar, make the rupee outflow. So ultimately on the date of repayment, you will know how much is the rupee home currency outflow. Option 2, you need dollar, fine, buy them. To be able to buy the dollar, you will have to pay your home currency rupee. So now you know how much home currency you will need to borrow to be able to buy the needed dollar, which was my starting point. So now when you borrow, you can know how much will be the rupee home currency repayment. Meaning to say, starting point is this or this, the end point will be this. Getting? Starting point, even in case of investment, is this or this, the end point will be this. That simple is the thought process. In case of borrowing, you should be able to understand you need to buy things or sell things. Primarily, you will observe the investment is a need-based situation. You need, which is why you buy it. Accordingly, the rate of bid ask you decide. In case of investment, it is primarily a sell situation. Something is there with me. What do? Sell. Accordingly, your bid ask gets decided. Right? I hope I'm able to deliver to you the needed conceptual clarity, people in the class. The question that we're going to solve on this is question number 74. Come on. An Indian company obtains following quotes. There is this Indian company. Question number 74. Do I find something in the OutNotes for this? Let me check. In the handmade notes for this. 76 is there, 74th luckily is there. Right. Sir, an Indian company, which means my home currency is rupee, which means my final outflow ultimately or inflow ultimately should be in rupee, obtains the following quote. Spot 3 month, 6 month forward rate. The company need dollar funds. Sir, I am an Indian company, despite what I need is dollar for 6 month. Two choices available. Borrow in dollar or rupee. If I need a dollar, then option 1 I can borrow in dollar. Sir, how many dollars? So they say whatever you do, take 100 as the amount. So if I borrow $100 for a period of 6 months, the dollar rate is 5.5. How much dollar will I need to repay? So sir, $100 I borrow. After 6 months at the rate of 5.5, interest will be 2.75 and I'll be needed to pay $102.75 here. Whatever you are needed to repay, buy those. See, common sense, when you need to repay dollar, what is the next step? Will you sell it? Sir, I already don't have it, I need it so that I can repay, so you will have to buy dollar. I went to the market, 6 months forward when I buy dollar, the rate is also of dollar and the other party sell 36.4 become the rate. So at this rate, when I buy $102.75 from my pocket, ultimately how much will go out? 3740.1, which means to get $100 here, I can, but against which the repayment here will be 3740.1. Option 2, you need $100 here, you can get $100 immediately. Rather than borrowing, this time you buy it in the spot market. So when I buy the dollar, how much rupee will I need to pay? So in the spot market, when I buy, other party sell. So 100 into 36.1 give me 3610, the amount of rupee to be borrowed today in the Indian bank. 3610. The rate of interest in India is 11.5. So at the rate of 11.5, when you repay, the rupee outflow, people in the class, is 3817.58 after 6 months. Meaning to say, in both the case, at 0 point, what will come to me is $100. So inflow at 0 point is same. So in that case, can I say out of the two options, whichever outflow is lower is a better deal? Here in rupee terms, 3740 versus 3817 says borrowing in dollar is a better deal because it leads to a lower outflow. That simple the question of borrowing become, or any other question of forex, as I said, become, if you are able to imagine it on the timeline. The B part of this question we are not discussing here. It relates actually to IRRM, interest rate risk management, pricing of forward, calculating forward rate using spot rate, which you have already learnt in the fixed income security also, along with IRRM, right? That relates to the second part of this question, which you will have to do at your own. The main part I wanted to teach is the borrowing, right? So that was all we had to do in this particular question. Now I take you to the next concept, and that is where the international financial management starts with, right? I hope you have realized the clarity with which we not only solve the question, we apply those, we not only learn the concept, but also we apply those concepts to the practical question, try to link those practical questions, try to fit those practical questions into the given concept. It brings ease and comfort. If you think the discussion is helping you out, please put up a like to this video. Subscribe to this channel so that you get similar further updates, and also more importantly, you can get my blessings, right? So I missed to realize who all are there in the live class. I'm really sorry. I missed to check who all do I have in the live class. Who all do we have? So Anjana is there, then Ujjwal is there, Subramanyam is there, Chandra Mohan is there. So I'm really sorry guys, I missed to see you all. There was some glitch. Now I'm able to see your messages. I'm really sorry. If you are listening to me now, kindly consider it. I'm really sorry. Very good afternoon. Okay. Great. Perfect. So what are we doing now? Taking you. So what I was saying, If you subscribe to my channel, along with the knowledge that I'm sharing, you'll also get my blessings, right? So anyways, jokes apart, wishing for your exemption, for your success in the exam. Anyways, sir, genuine feedback, genuine request, comment down the literal feedback when you have by watching up this video right in the comment section, right? It helps the other students, the juniors, to get trust on the video. And I'm not asking for the positive comments. Put down your genuine feedbacks. If you feel positive, type down positive. If you feel negative, type down negative, is what I'm saying. Yes. So anyways, now we come to international cash management, the first topic from international financial management. Extremely easy. It is more or less same to the concept of foreign currency investment that we have done, right? So people in the class, let's get immediately started. Sir, what it says that there is a parent company. Imagine that parent company is an Indian company and it has subsidiary companies, suppose in US and UK. All these three companies which operate in respective country have their own cash requirement and cash availability, right? To do the business you need cash. At some point cash is excessively available than needed. At some point it is less available than needed, which means sometimes we have deficit. What do we do? How do I manage that cash? Two ways. One is centralized. Centralized means India, being the parent company, has rupee cash excess available with it. US, being the US subsidiary, has dollar excessively available. So one way to manage is that whatever excess you have, you sell it and transfer that rupee to the parent company. US company say we have these many dollars extra, that extra dollars you sell, against which you will receive rupee and transfer that rupee to the Indian parent. So Indian company had rupee which is there, US subsidiary had dollars which is sold and converted to rupee, and UK company, rather than having the availability of pound, they have deficit of pound. So if they have deficit, they will buy pound, for which the rupee will be paid by the parent company. So overall at 0 point itself, parent company will know that net, considering all the excess, surplus and deficit, considering all the surplus and deficit, how much is the net rupee, which is its home currency, is available with itself. That rupee amount will be invested in India, obviously, because we have rupee in hand, and after a year we will see how much amount gets redeemed. Imagine that this excess amount and the deficit were for a period of 1 year. That is one way. This is centralized cash management, where all the surplus and deficits were centralized in parent's currency and then managed. Another is decentralized cash management system. Respective surplus and deficit of parent and subsidiary is not brought to a single parent's currency. No, they are at their own independently managed. Indian company, if it has anything extra, will invest and redeem at its own. US company will invest and redeem at its own. Pound, UK company had deficit, it will borrow and repay it at its own. You know what is the main point? The main point is that rupee gets invested in India at rupee rate of return, dollar gets invested at dollar rate, pound gets borrowed at pound rate. So ultimately know how much is the rupee and dollar I will redeem after a year and how much pounds I will need to repay after a year. Correct? When I redeem rupee, I can sell that, I have the rupee in hand already. When I redeem dollar, I can sell those dollars and receive rupee. Similarly, when I need to pay the pounds, I need to repay the pound, so I can buy the pound and figure out the amount of rupee to be paid. And ultimately, in the end of 1 year, when my time period gets over, I can figure out how much is the amount of rupee I am finally left with. This way, what is happening? In the first case, I am ultimately left with the amount of rupee available. 1 second. In the first case, I am left with the amount of rupee available with me. Even in the second case, I am finally left in my home currency, in parent's home currency, the amount of rupee available. In whichever case the inflow or the cash balance in rupee is higher, is a better deal, is a better choice. You have to do simple. The difference is, in the centralized, you convert to parent currency first and then you invest. And for the purpose of conversion, since it's happening today, you use today's spot rate. In the decentralized, you first invest and borrow in the respective currency and ultimately do that conversion at the forward rate and get to know the final amount in rupee. So first the investment borrowing happen and then the conversion happens later, and that too at a forward rate. This is the simple difference, using which if we solve a practical question, you'll be able to connect how simple everything is. Question number 79 from the study material, let us solve. Or maybe we can solve 78th question in the study material. Come on, 78. AMK Indian based company has subsidiaries in US and UK, right? Forecast of surplus for the next 30 days are as below. US has $12.5 billion extra, US has pound 6 billion extra. Following exchange rate obtained: dollar per rupee, pound per rupee today and 30-day forward rate. Borrowing deposit rate in the country, respective country has been given. Indian operation has deficit of 500 million. The other two country had surplus, Indian operation had deficit. Sir, you have two choice. Invest own cash independently, means decentralized, or pool everything in India and invest that pooled amount is centralized. Let's think one by one. Just give me a second, let me have water, then we continue. Just give me a second. Yes, so come on, people in the class. What it says, extremely easy. It says AMK Indian based AMK Indian based company. So ultimately you have to realize that since the parent company is rupee, all these things in case of centralized will be converted to rupee. What are we solving first? Let's solve the decentralized first, right? Let's solve the centralized first. Sir, rupee 500 million deficit, a negative number. The other two respective currency, positive number because they are surplus. In the spot market we have only one rate, no bid ask, life is easy. Let's convert the respective currency to rupee. Let's go to the market, sell them. Since the rate is rupee, we will divide it. 12.5 divided by 0.0125 give me 0.0215 give me rupee 581.396 million. You can also make it till 4 decimals after the 4 digits after the decimal point because it's in million. Similarly, when you sell 6 million using this rate, divide by 0.049 gives me 402.684 rupee available. These two amounts are available. This one is deficit, so that goes out of my pocket because that gets invested in the business. So the net amount available with me is 484.08. That amount when invested in India at the rate of 6.4% for a period of 30 out of 360 days, how much it turns out to be? Sir, at the rate of 6.2%. So sorry, I by mistake said 6.4 because when I borrow it is at the rate of 6.4. When I invest, I will get only a rate of 6.2. So let's invest this amount at the rate of 6.2% for a period of 30 days and earn this earn this interest. So the total amount which gets redeemed is 486.58. Are you able to understand the rhythm or the flow of the question? Yes. Similarly, this was centralized. Sir, whatever you have done on the timeline is basically we are doing here just that. Out there the timeline was horizontal, here the timeline we have made is vertical. This is 0 point converted to another currency, then this is after 6 months the final amount redeemed. Similarly, if it is decentralized, we invest and borrow the respective amount using respective rate. For example, 500 rupee, we borrow at the rate of 6.4 for a period of 30 days. It become 502.67 million as the amount of repayment after 30 days. Similarly, 12.5 and 6 million when you invest at the rate of 1.5 and 3.7% for a period of 30 days. The amount that you redeem in respective currency is $12.515625 and pound is 6.0185 million. The redeemed amount, let's go to the market to sell it. Since that's after 30 days, I will make use of forward rate. So divide by 0.0217 and divide by 0.015 gives me in rupee how much amount you have available with you after 30 days, out of which this is the amount of repayment to be made, and the net amount available with you is 475.32. In both the cases, if you compare both the cases, the centralized cash management is better because it leads to the higher amount of closing value, which is 486.58. That is how the question for international cash management are being done. People, am I able to convey to you how exactly the international cash management concept is linked to the question and what this concept try to say? The next, people in the class, is international capital budgeting. What happens in this concept is again easy. If I tell you what is a capital budgeting, so it's a simple thing. I am a company. I have an outflow to be made. And if I make in this outflow today, if I invest this amount today somewhere, I will have future inflows. This is capital budgeting. We call it international capital budgeting when I am an Indian. I want to invest in US, so my initial outflow will be dollar. The amount of inflows I will have will also be dollar. In that case, how do you capital budget? How do you calculate NPV is the question. So let's understand it in a simple way. Sir, there are two approaches to solve this or to calculate NPV. I know my initial outflow is dollar. My annual inflows every year is also dollar. If I need to invest, if you want to invest somewhere, what will you do today? You will buy that foreign currency dollar. So you will pay your home currency rupee today. So ultimately now you have outflow in terms of rupee, right? Rupee is what? Rupee is your home currency. Agreed? To invest, you need to buy, which will give you automatically the outflow in home currency. Since you make an investment today, you will receive future dollar inflows. You will receive the dollar inflows. Whatever amount of dollars inflows you will have, you sell those dollars. Because ultimately you need your amount in the home currency. So you sell it and you receive your home currency rupee inflow. I am saying if you are able to imagine the concepts on the timeline, if you develop this approach which I am trying to teach you in this video, which we have done in all our batches, every question of AFM you make easy. Yes. So back to the point, rupee outflow and rupee inflow of every year. Now do you realize this question has become a simple question of NPV that we've already done at C-enter level. You have a discounting rate, discount these inflows, you have the present value of inflows, deduct the present value of outflow from it, and you get rupee terms home currency NPV. Now something you need to understand without me explaining it, which is, sir, if you have dollar inflows of future date, when you sell them, they will either be sold using the forward rate or the ST of respective year end. When you buy dollars today, it will be using the spot rate of today. When you buy dollar, you will have to think between bid ask. When you sell dollar, you will have to accordingly think between bid ask, and that's how home currency approaches. Yes, are you getting it? Sir, foreign currency approach, let me talk about. Foreign currency approach. Why was it named as home currency approach? Because sums, the cash flows, were first converted to home currency and then the NPV was being done. In the foreign currency approach, if I have dollar outflow and dollar inflow, first I calculate the NPV in terms of dollar only. I discount all these dollar cash flows to calculate present value of cash inflow, deduct the initial outflow of dollar from it, and ultimately I have dollar NPV with me. Yes, आपके पास sorry, I by mistake used the word Hindi, I missed to realize it. Sir, you have the dollar amount, dollar NPV with you. Since it is the amount of NPV today at 0 point present value, you convert that NPV to rupee NPV using spot rate of 0 point, finally getting you home currency NPV. That simple is the situation. Main point is that to discount rupee cash flow, you need rupee discounting rate. To discount dollar cash flow, you need dollar discounting rate. Sir, are the two currencies discounting rate different? Yes, similar to the interest rates in two countries, the discounting rates are also different, because if you're able to recollect the basics, how many of you remember the basics that a discounting rate, which is nothing but a required rate of return, comprises of a risk-free rate and risk premium. Rate of risk-free rate of return in India will be different and in US will be different. So accordingly, can I say, since RF is different, the discounting rates of these two currencies will also be different. So what is the relationship? Let us observe. Sir, 1 plus discounting rate. The relationship is not additive, it is multiplicative. Sir, 1 plus discounting rate of foreign currency is 1 plus risk-free rate of foreign currency into 1 plus risk premium. Similarly, 1 plus the discounting rate of home currency, suppose rupee, is the 1 plus risk-free rate of rupee in India plus the risk premium. Whenever examiner give you a discounting rate, that is always assumed to be the discounting rate of home currency. I'm an Indian company. When I say I need a 15% rate of return, I obviously mean to say about the return on the cash flows which are in India, home currency, in rupee terms, correct? So if I have home currency rate, I can directly use it. However, if I want to use it for the foreign currency approach, what do I do? Sir, using Indian home currency discounting rate, using rupee Indian risk-free rate, I first calculate risk premium. Risk premium has nothing to do with the currency. It relates to a particular project, not the currency or country. 1 plus risk premium, if I calculate, it will be the same risk premium here in case of foreign currency discounting rate. So using the risk premium and using the risk-free rate of foreign currency, I can calculate the discounting rate of foreign currency. Are you please getting it? Are you please getting it? Tell me. People in the class. Come on. So that's how the question for international capital budgeting will be. Just last thing to teach you. Sir, will the examiner give you all these spot and forward rates? The answer is may not be. If I have been given the spot rate of 0 point and I have been given if the inflation rates, or I have been given if the interest rates, then using interest rate parity theorem or purchasing power parity theorem, can I calculate the future spot or forward rates? Yes, and those spot forward will be then used to convert these dollar cash flow of future years to the rupee or home currency cash flow. Right? So I think now everything seems sorted. Let's proceed to solve a practical question of this category. Sir, let me figure out which question should we solve. Let's first of solve question 82. 82. The question of home currency approach asked by institute multiple times. An ambiguity it has, which sometime institute asks, sometimes doesn't ask. So let me proceed. DD Limited, a company based in India, manufactures good quality of leather bag and sells to retail outlets in India and USA. Sir, I'm an Indian company. My home currency is rupee, which means ultimately the NPV or all the inflows and outflows finally has to be in rupee. I manufactures good quality leather bag in India and US and export to India, US. Cost of leather in India is very high. Company is reviewing a proposal to import in bulk from US supplier. So I am an Indian company. I am planning now to import the leather from US, manufacture it in India and sell to India and US both. Export to India and US both. The estimate of net USD and Indian rupee cash flow. In terms of dollar, in terms of rupee. When I export in dollar, it's a US cash flow. Import from US, dollar cash flow. Right? And similarly India, US and rupee cash flow net, right? In nominal terms for this proposal was import from US and sell to India and US. This is the proposal. The cash flows are given below in lakhs. In the year 0123, USD 0.25 lakh dollar outflow, 5, 7 and 8 lakh dollar inflow respective year. Rupee terms 60, 80 and 90 lakh rupee inflow. If not imported, if you don't import the leather from US, the cost of leather that you will have to purchase in India is 400, 450, 500 and 600 at the end of every year. Fine? Cool. At the end of every year. Sorry, someone was making some drawing in that. I'll have to check what that drawing is. Anyways, sir, other information. DD evaluates all investment at a discounting rate of 9%. Your discounting rate, home currency discounting rate is 9%. All US customers are invoiced in dollar. Obviously, we are invoicing them in dollar, which is why the cash flows are in dollar. US cash flows are converted to rupee at forward rate and discounted at Indian discounting rate. Means we want to follow home currency approach, where all these dollars are first converted to rupee. Then I have all the cash flow in rupee and then I calculate rupee NPV. Inflation in US 9, India 8%, fine. Exchange rate at present rupee per dollar 74. 9% discounting rate has been given. We have to calculate NPV. Really simple. Convert these dollar inflows outflows to rupee inflow outflow, but for that we need an exchange rate. So first, using spot rate and the inflation rate, let's calculate the expected spot or forward. Please understand interest give you forward, inflation give you ST, but there is a theorem called as international Fisher effect, because of which interest can also give you ST and inflation can also give you forward. That is what I want to tell you. Are you understanding? Inflation can also give me a forward rate, which is why, and the theory has no other use in their curriculum, which is why they are not talking about it, which is why despite giving inflation, despite getting inflation, we will calculate forward rate. Fine. So let us proceed. So India, 74 is the rupee per dollar rate. Using purchasing power parity or interest rate parity, Indian rate of 8% will be multiplied and 9% will be divided. 74 into 1.08 divided by 1.09 is 74 multiplied by 1.08 divided by 1.09 is 73.32. Since we have to make the calculation till 2 digits, we are keeping it till here. Else we could have done it till 4 digits after the decimal point, 73.32. Then again multiplied by 1.08 divided by 1.09 is 72.648, which is 65, and similarly 71.98. These 4 inflows and outflows of dollar, using these rates, when you convert, you get the outflow in rupee terms of those US cash flow. So 25 into 74 give me 1850 initial outflow, 366, 508 and 575 every year's inflow in rupee terms. To that, can I add my actual rupee inflow? 60, 80, 90, 60 added, 80 added, 90 added. Now the ambiguity. According to me, this particular thing was supposed to be ignored. They say if not imported from US, these will be the Indian rupee outflow to buy that leather. But in this case, we have already considered import of leather in US. Hello? Leather we have already imported. That is what the proposal it is, and related to that proposal the cash flow has been given, which means this cash flow includes the cost of leather being imported from US. Correct? If that is there, if that outflow is already considered, why will you again show something as an outflow in India? Sir, that is the ambiguity. Cost of leather not imported has been shown as outflow. Instead, you added this part, then in some attempt or some RTP, MTP again removed this part. I am making you do this question with this ambiguity there. If you are lucky, examiner will not give you this line. If the examiner gives you this line, then how should the treatment be? Despite being illogical, you will have to show it as outflow and then ultimately calculate in rupee terms finally how much will be my inflow outflow. Discounted at the rate of 9% factors being given, you calculate the inflow. When you calculate NPV, it is a huge negative number. My NPV, people in the class, is a big negative number, means we should not do this project. The project is not viable, which is question number 82 we have done. Are you understanding? Are you understanding? This is which approach? This is a home currency approach. Give me a minute. Wait. One more question I would want you all to solve is question number. Just wait for a minute. Fine. Boss, one question that we're gonna solve now is a question I will show you. But before that, I want to show you a particular question, question number 89. Although this question is there in the forex, right? Because it talks about the language which this question has relates to forex, right? And this question is being asked and is there even before the chapter of advanced capital budgeting was there in CA final AFM. Even this question, if looks of forex, this question actually belongs to the advanced capital budgeting decision, where we have learnt about the replacement decision. Whether I should replace a machinery or not, that is the concept which belongs to. So if you are trying to solve question number 89, which is this particular question, make sure you're comfortable with this very easily explained concept of replacement decision in the advanced capital budgeting chapter, then you attempt this question. Right? After learning replacement decision, from there this question is to be done, which then you will find has got no relation with forex. It is all the question of advanced capital budgeting decision, right? Since we have not discussed capital budgeting replacement decision in this video, which is why I am not taking this question now, else we would have done this question, right? Having said that, I will take you to the next question. The next question, people in the class, relates to two small questions I'll take you to. First, question number 81. This question actually does not belong again, does not fit to the concept that we have done, right? Is a bit different but easy question, and which is why I'm doing it in the class, because it does not fit to the concept that we have learned. In this question, there is no discounting of cash flow, nothing. It is all simple. I will directly explain the question to you. It says there's this US based company. So the first learning of this question is that in this question, you have rupee as well as dollar. In the absence of information, we start to assume ourselves of India and obviously solve everything to rupee. But when they say there's this US based company, you should realize that in this case your final answer has to be in dollar. Your NPV or inflow, outflow, or anything has to be in dollar. So there's this US based company who's planning to set up a software unit in India, right? So US company planning to set up a software unit in India, right? Sir, Indian unit will develop the software and transfer. The software developed at Indian unit will be bought back by US parent at a transfer price of $10 million. At a price of 10 million transfer price, and software will be transferred by Indian entity to the Indian unit to the US entity. US based companies subject to 30% corporate tax rate, 10% withholding tax rate. Software will be sold in the US market for 12 million. $12 million is what US company will sell the software in the market. Other estimates of cost. In India, we will incur different cost. What cost we will incur? The rent cost, manpower cost, administration cost. Three different costs we will incur in India. Fine. Along with that, in India, we will incur two types of tax. Corporate tax and withholding tax. In India, I will have total 5 costs to be incurred. Advise US company on the viability of the project. Should the US company do the project or not, which means final answer has to be in dollars. You all might think that if you want to advise from the point of view of US company, the life is really easy. 12 million is my inflow when I sell the software and 10 million is my outflow when I buy the software from the Indian unit. Is that simple the question? No. Then what is the logic? The logic is this 10 million is not a cash flow. It is only for the purpose of taxation, your transfer price, your fair price, arm's length price. Meaning to say, Indian entity being the relative of US entity, when sells the software without any price, it does not have a tax liability. It does not have a tax liability. For the purpose of taxation, the income tax department says will assume the price to be $10 million. From that revenue which Indian unit has earned, you will deduct all your expense. From that notional revenue, using that revenue, you deduct all your expenses to calculate the profit before tax. This is the notional profit calculated only for the purpose of calculating corporate tax and withholding tax. Once you get these two tax, you will know all your amount of expenses. So you don't have to think from Indian unit. You in fact have to think holistically. That holistically where two units are one only, sir, how much is the total outflow in rupee including the taxes, and how much is the final inflow in dollar, using which you will have to calculate the dollar profit, which is the NPV or answer to this question. Point one learning, 10 million is not the actual inflow outflow, it is just the notional revenue. So that on the notional profit you can calculate the amount of actual tax. Correct? So let's proceed. We will say revenue being notional. Revenue being notional. Revenue being notional. 40. So 10 million multiplied by 48 rupee per dollar rate, 48 lakhs revenue, from which different cost when you deduct, you get the PBT of 36 crore 5 lakh, at which when you pay 30% tax it is 1081, after which when you pay withholding tax it is 252. When you add up all your expenses, adding up all your expenses will give me 25, 28, 85. When you add up 5 numbers, it becomes 25, 28, 85. Other choice which institute has done is, rather than calculating the total cost, from the revenue deduct the profit. From the total revenue, it will deduct the profit. Automatically, you will know how much is the total cost, which will also give you 25, 28, 85,000. Correct? This is the cost in India rupee outflow. If you convert it to dollar, you will know your dollar outflow. Similarly, the dollar inflow is 12 million when you sell that project. Where is that 12 million? The dollar inflow is 12 million when you sell that project in the US. So from that inflow, if you deduct the rupee cost outflow, those 5 costs converted to dollar, rupee outflow converted to dollar, you will get the dollar amount of NPV. That is the explanation of this particular question. Question number 81. Are you able to connect to me? Are you able to connect to me, people? So that is question number 81. I will explain you one more question. That one more question actually is 85th question relating to currency swap. So I am in this video also trying to cover those questions which are typical in nature, which are maybe easy, literally easy, but a bit different in nature, does not as it is fit to the concept. Question number 85. Come on, the question again from the study material asked by the institute in November 24 attempt. Okay, come on. I will run a poll tomorrow on the Telegram regarding which is the next chapter you want. Cool? So come on. True Life Incorporation, a US based company. When someone says I'm a US based company, I realize that my home currency is dollar, has won a contract to implement a project in India. The project will require initial investment of 8,000 million. Are you realizing? I'm a US company. I need rupee to invest. I have dollars, but I need rupee to invest. The whole project will be sold to Indian government for 9600 in 1 year's time. Listen to me what's happening on the timeline. At 0 point, we need to invest rupee 8,000. Right? To invest, there's an outflow. The same amount will get redeemed after a year, which means the Indian government will buy that entire project and give me 9600 rupee. Fine. Cool. Since the Indian government will they pay the amount in rupee, the company is worried about the exposure. Fine. Construct a swap that will help to reduce the exchange rate risk. Construct a swap. Sir, swap, as I told you in the interest rate risk management, is the exchange of cash flow. So this True Life Incorporation, which know that it will have to make the payment of rupee 8,000, should be able to buy 8,000 rupee. So it will buy 8,000 rupee today from someone in the market, against which it will pay dollar, which it has, right? It will buy rupee and it will pay dollar to the other party which it has. Fine. After buying that rupee, the same amount will be used for the purpose of investment logic. After a year, it knows that it will get 9600 from Indian government. So do you agree, after a year it should go to the spot market to sell that rupee and receive dollars back? But the uncertainty is what will be the rate after a year, that we don't know. So which is why today at 0 point, let's enter into a contract. Let's enter into a swap contract with the other party. The swap contract is like, today I am buying rupee and paying you dollar. Tomorrow at an agreed rate that we agree upon today, on a later date at that agreed rate, I will sell rupee back and buy my dollars, receive the dollars, and I will sell you rupee. This kind of swap contract, when you enter into, you don't have to be dependent on the dollars. So it is like, you will agree that those $8,000 rupee which I bought, I will sell you after a year, against which you pay me dollar. So with this agreement, what will happen? Out of 9600, which is the total amount of inflow you have, at least you will be able to sell 8,000 at an agreed rate, which is fixed today only in a contract. And you will be left with the exposure of only 9600 rupee, which you will go to the market and sell. That simple is the solution, a theoretical solution to first part, right? The second part, assume the Indian government offer a swap at a spot rate which is rupee per $80 in 1 year. What a line. Said today the spot rate is rupee per $80. Today the spot rate is rupee per $80. Using this spot rate, people, at this spot rate, the Indian government agreed to enter into a swap, that let's enter into an agreement today that even after a year you will be able to sell that rupee at the rate of 80. Correct? And we are expecting that ST will be 84. We are expecting that ST will be 84. Should we accept the offer by Indian government? So let's understand how we gonna solve it. Let me just give me a second, open the handmade solution. Cool. You look at the solution. The solution, everyone, is really easy. Sir, let's understand, to the US company in its home currency dollar, what are the outflow today and what will be the inflow in both the case. If we accept the swap offer of Indian government, if we don't accept it, in both the case. Sir, in the first case, if we accept, sir, today to buy 8,000 rupee at the rate of 80, I need $100 million outflow. It will be $100 million outflow from my pocket. Cool. After a year, when I receive back 9600, out of 9600, at the rate of, out of those 9600 rupee, 8,000 rupee I will sell back at the rate of agreed swap of rupee per $80, and I will receive my $100 back. Rest of the 1600 rupee I will sell in the spot market using the rate of 64, and I will receive $19.05. Everything is million. Sir, last thing. Examiner says the interest on USD loan is 6% per annum. So remember to make use of this information. Sir, how do I use? Assume that this $100 million you borrowed, for 1 year at the rate of 6%, you have to repay 6 million interest. So the total inflow, right, that 9600 rupee that you received when you sell back in dollars, it is 119.05, from which you pay 6 million interest, it is 113.05. However, without the swap, without Indian government's offer, you will buy 8,000 rupee, you will have to pay $100 for that. You will sell entire 9600 at rupee per $84. You will have an inflow of 114.29. Correct? Dollars. Interest $6 million you will have to anyways pay. The final inflow is 108.29. So obviously swap is a better deal because it leads to higher home currency dollar inflow of 119 as compared to without swap. So swap is preferable. Question 85th I explained. Correct? So I hope I am able to explain to you all those things which are needed from exam point of view. The next concept, people in the class, we need to learn, where we will solve one more practical question, is the concept of adjusted present value. A really easy concept of adjusted present value. Sir, what happens in this concept? It is an extension of calculating NPV, but the approach is slightly different. Sir, in this case, we start to give effect even of the capital structure. For example, when you see here, international capital budgeting, generally, in fact, in the capital budgeting that you have learnt in C-Enter or even at the final level capital budgeting, we never give the effect of capital structure to the cash flows that we calculate. Do you consider the interest cost in your cash flow? No. I never deduct interest from the EBIT to calculate PBT and then deduct tax to calculate PAT. What do I rather do? Let me explain. Sir, the basics of capital budgeting, are you people understanding? The basics of capital budgeting. Since we don't give the effect of interest there, in this adjusted present value, we will learn to give the effect of it in a different way. Adjusted present value says, suppose you want to invest 300 rupee in a project. How did you get this 300? Sir, 200 you get from equity and 100 you get from debt. So it says that you assume that entire 300 is equity financed. You assume that and calculate NPV. If it is all equity financed, will there be any interest payment? No. The discounting rate will be KE. Agreed. With this assumption, calculate NPV. That outflow is this. From that project, every year will be some inflow. Discount those inflows using the rate of KE and calculate NPV. That is called as base case NPV. Cool. Discounting rate KE, base case NPV. Now, you figure out that rather than equity, if the amount of rupee 100 is raised by way of debt, on this rupee 100, which is if raised by debt, what will be the impact on my NPV? The impact is that on this 100 rupee, I will have to pay interest. Fine, but no problem. Rather than paying interest, which is the cost of debt, even if you raise this amount from equity rather than debt, you will have to pay the cost of equity. So from the pocket of the company, the amount has to anyways go out, or for the purpose of calculating NPV, the cost has anyways be considered. Previous it was cost of equity, now it is cost of debt. Anyways considered a kind of outflow from my pocket. But then the question is, then what is the point? The point is, when you pay something to equity as the cost, there is no tax advantage. But if you pay anything to the debt, the same amount that you pay to the debt, it gives you tax advantage, meaning to say 100 rupee paid to equity company does not have any benefit, but 100 rupees when paid to the debt, it gives you 30 rupee of tax benefit and only 70 is the net outflow. So first, even if an amount was raised through debt, I assumed it to be all equity, but in reality it has been raised by debt. So you give the effect of tax benefit, that rather than paying that 100 to equity, if you pay to debt, what will happen? You will have the savings in tax. The outflow doesn't matter. The outflow anyways had to happen whether it is equity or debt. But the tax benefit of that outflow, which means that 30% component, is what I'm concerned about, that every year when I pay interest, I will have the tax benefit. So of the interest, on the interest, whatever is the tax benefit in the future year, the present value of those tax benefit I consider here as my inflow. So to the base case NPV, when you adjust some things, we call it as adjusted NPV or adjusted present value. Sir, what is the second adjustment? To raise the debt, I might have to pay a flotation cost. When I pay 500 rupee of flotation cost, I will save 30% of tax. So effectively 70% of that 500 rupee is the outflow I will have to make. So these two adjustments when you do to the base case NPV, the NPV is so calculated as the adjusted present value. So remember, if you need to do any discounting for second and third item, the discounting rate, since it relates entirely to the debt, the discounting rate is the pre-tax cost of debt. Pre-tax cost of debt. Are you understanding? Pre-tax, specifically remember, not only KD, it is pre-tax, because benefit of tax has already been taken in 2 and 3 both. Benefit of tax has already been taken. Done. So now let me take you all to the practical question of this type, which is people in the class practical question number 91. Cool. So let's start to read question number 91 super ultra fast, everyone in the class. Come on. The management of multinational company is engaged into construction of infrastructure project. A proposal to construct toll road in Nepal is under construction of management. Sir, this company does not belong to, belongs to which country we don't know, but it is considering to construct a road in Nepal. The following information is available. Initial investment will be USD 250. To purchase the equipment, you will have to invest USD 250 lakhs. Fine. So investment is in Nepal, but is in terms of dollar. I am which country? No knowledge. The economic life of the equipment is 10 year. Depreciation will be charged SLM basis. So 25 lakhs per annum is the amount of depreciation. EBITDA to be collected from the toll road is projected 33 lakhs per annum for a period of 20 years. So total for a period of 20 years, I will have an EBITDA, earnings before interest, tax, depreciation and amortization, of 33 lakhs. Depreciation on which will be charged only for the next 10 years. Fine. To encourage investment, Nepalese government is offering 15-year loan of USD 150 lakhs as an interest rate of 6% per annum. Interest is to be paid annually. Loan to be paid in one tranche, one shot at the end of 15 years. Sir, this is the information regarding debt. We will look at this information later on because my initial assumption for the base case NPV is that I am all equity financed. Required rate of return for all equity financed is 12%. Fine. Cost of debt 5.6, doesn't matter for now. Corporate tax 30. All cash flow USD, ignore inflation. First of all, did you observe there is no need of exchange rate? Inflow dollar, outflow dollar, no exchange rate given. My final answer will be in dollar. Sir, you are required to advise by calculating adjusted NPV. So let me assume that this entire investment of 250 I make through equity. Let me calculate my inflows using EBITDA and depreciation and then proceed ahead. Sir, EBITDA for the first 10 years is 33 and next 10 years is 33. From which I deduct depreciation of first 10 years as 25 and then 0. So accordingly, earnings before interest and tax, and assuming no interest, earnings before tax is 8 and 33 only. From which if you deduct 30% tax, it is 2.4 and 9.9. So earnings after tax is 5.6 and 23.1. To earnings after tax, when you add back depreciation, what we calculate is CFAT. This is something very basic. You have already learned in advanced capital budgeting decision, another video of another chapter. Cool. CFAT, people, when you add back depreciation, you calculate CFAT of 30.6 and 23.1. Means for the next 10 years, the cash flows that I will earn is 30.6. And after those 10 years, the cash flow I will earn is 23.1. And I need the present value of all those 20 years cash flow today. Examiners say at the rate of 12%, which is my all equity rate, at the rate of 12%, for the next 10 years, present value is 5.650. Fine. Sir, at the rate of 12%, for the next 20 years, the present value is 7.469. So, sir, next 20-year present value is 7.469. Next 10-year, the present value is 5.650. So, from 11 to 20, what will be the present value? This minus this. 11 to 20, present value is this minus this, which is 1.819. Present value of future cash flow of 11th to 20th will be 1.819. So overall, 30.6 being the cash flow into annuity factor, 23.1 being the cash flow into annuity factor give me the overall present value as this and this. Adding gives me 214.9089, which is the present value of cash inflow assuming all equity financed. Minus the initial outflow of 250 give me base case NPV as a negative number of 35.0911. 35.0911. Now what? Sir, now giving the effect of debt. Rather than raising this entire 250 from equity, if I raise this 150 from debt, what impact does it have? The initial inflow, right? Rather than raising from debt, if I have rather than raising it from equity, if I have it from debt, the initial inflow does not change. It continues to remain 150, which means overall I continue to receive 250 from public, and I make that investment. Then what is the impact? Does the repayment has any impact? The repayment of 150 back? No. Rather than paying that entire amount back to the debt, once the project is over, I will have to pay it back even to the equity. Does not have impact even on the outflow. Then what is the impact? The impact is when I take an amount from debt, I have to repay interest on it, and paying that interest saves tax. So 150 lakhs, when I pay on this amount, when I pay 6% interest, it is 9 lakh USD of interest. When I pay 9 lakh every year, I will save 30% tax on it, so that 30% portion being saved every year is 2.7. For the next 15 years, when I do that, how much is the present value? Please look at this. Present value at what rate? KD, and that too pre-tax. If post-tax KD is 5.6, pre-tax KD will be divided by 70%, which is 8% is the pre-tax KD. What did I do? Sir, cost of debt into 1 minus T. Pre-tax cost of debt into 1 minus T is post-tax cost of debt. If post-tax cost of debt is 5.6, dividing 70% by it will give me pre-tax KD of 8%. Yes, so at the rate of 8%, for a period of 15 years, when I save 2.7, the present value is 23.109 lakhs of those future tax savings. Is there a flotation cost? No. So 35 lakhs negative was base case NPV, adding tax benefit of interest to it is 23 lakhs. Overall, I end up having adjusted NPV negative and the project people in the class is not viable, that is how question number 91 is being solved. I hope you are able to understand that it is application of the concept that you have learnt. The next and the last question of this chapter relates to the concept that I am going to teach you now, which is extreme easy. Give me a minute. The concept of American depository receipt, global depository receipt or Indian depository receipt, really simple. Sir, I am an Indian company. If I want to issue my share and raise money, I can do it in India. Yes. For example, ICICI Bank, if it wants to raise money in India, if it can issue its share in rupee. Can it raise money or issue its share in US? Yes. But how will it do it? Let's understand. ICICI Bank will issue its share to this authority, to an authority called as Depository in US. The US Depository will in turn issue a new security to the US investor called as Depository Receipt. That depository receipt which these investors will buy ultimately shows nothing but it shows the claim of these investors on the shares issued by ICAI. Each depository receipt might have a claim over 1 or 2 or 4, whatever number of share. So meaning to say, the price of this depository receipt depends on the price of share in India. So for example, price of shares in the India increases, the price of depository receipt will also increase and so on. Sir, first, one depository receipt can represent a claim over multiple shares. Second, when Indian company ICICI Bank issues shares in India, that's in rupee, but these are in dollars. So if the rupee per dollar rate in the market will change, then due to that as well, the price of this depository receipt will get affected. Agreed? Now, when these depository receipts are issued in America, country, we call it ADR. When a US company issue that depository receipt in India, which means they come to Indian authority, issue the depository receipt by Indian authority, sir, that is IDR and so on. Correct? Sir, what is examiner going to ask? Examiner is going to ask you that at the time of first time issue, what will be the different calculations? For example, they say there is the Indian bank who want to issue shares in US. So share price India is rupee 50. We want to issue depository receipt, where one depository receipt will have a claim on 4 shares. Fine. How much should the price of each depository receipt be? So you'll be like rupee 200. But they say that we want to issue it at discount. How much discount? For example, 10%. So one depository receipt should be 180 rupee. Fine. But how much will it be in dollars then? Because if the rupee per dollar rate is 80, then if the rupee per dollar rate is 60, then divide by 60 give me $3 should be the issue price of one depository receipt. Then they'll say whatever you issue, you end up incurring 2% as your flotation cost. When I issue share, I have to incur some cost. So net how much will I receive? 3 minus 2% as $2.94 as my net proceed. You have to understand there is a difference. One is issue price, the price at which I issue. Net proceed is what I ultimately get back after deducting flotation cost. Last common sense will be, if I want to raise a total of $294, the amount I need to start a project in India, in US for example, the amount that I need in total, suppose is $294,000, right? each GDR will give me, each ADR will give me $2.94. Sir, how many GDR you will need to issue? Sir, it is 1 lakh GDR I will need to issue to be able to fund this project. That simple is going to be the question, everyone in the class. So let us solve a practical question, right? These are the formulas I have typed down for you, but they are more of a common sense that every GDR has 2 shares where price per share is 50 and I am giving you 10% discount where rupee per dollar rate is 60. So it is like every GDR has 3 shares, for example, sorry, 4 shares. So $3 is the issue price. From $3, if 2% flotation cost is deducted, 2.94 is the net proceed. So if I need $2,94,000 as my total amount and per dollar proceed is 2.94, how many number of GDR I need to issue? 1 lakh. That simple is the solution. One more thing, calculating the cost of depository receipt. Do you remember the cost of equity, Gordon's formula, D1 divided by P0 plus G? Very similarly, for the depository receipt, it is D1 divided by net proceed. The common sense is really simple. Whatever net proceed I will receive, on that net proceed I will have to pay a dividend. And along with that, there will be a growth in the price of share or price of depository receipt, which is also a return for the investor. So the total return for him or the total cost to me is D1 divided by net proceed plus G, being the cost of depository receipt. Yes, so based on that logic, people in the class, based on that logic, if I solve 92 question which has been asked by the institute multiple times, you'll find it extremely easy. Raghu is interested in expanding an operation in US, for which it needs USD 8.82 million. Raghu is an Indian company, right? But it has to make an investment in US, which is why it's planning to raise an amount from US only, correct? How much does it need? 8.82 million. Flotation cost is 2%. Expected market price at the time of issue is rupee 360. Of this company in India, 360 is the market price, face value being 100. Each GDR will have 2 shares. Fine. So 1 GDR in rupee terms is how much? 360 into 2, 720. The issue will be at 10% discount. So minus 10% is 648 rupee being the issue price. Since the rupee per dollar rate is 72, divide by 72 to give me $9 being the issue price of each GDR. Dividend being 20%, growth rate being 12%. Find the number of GDR to be issued. So every GDR get me $9. Every GDR I issue at $9 minus 2% flotation cost give me 8.82 as the net proceed. 8.82 million is what I need total, and every $1 that I issue, every one depository receipt that I issue give me $8.82. So how many million GDR I'll have to issue? 1 million GDR is the number of GDRs to be issued. Cost of GDR, really simple. Sir, I make total how much dividend payment? Sir, it says dividend is expected 20%. Expected means D1 has been given. So sir, on a face value of 100, 20% is 20 rupee dividend. 1 GDR has 2 shares, so total 40 rupee dividend. And since rupee per dollar rate is 72, amount of dividend in dollars how much? Amount of dividend in terms of dollar is 0.5556. So D1 divided by net proceed of $8.82 plus growth of 0.1 to give me the cost of GDR as 18.3. That is what the first part of this question. Second part says the US bank is ready to give you 12% loan rather than issuing the shares in the US market. Raise money from share at the rate of 12%. So should you accept the offer? We say we accept the offer. Practically not comparable, because one is raising money from equity which has no risk to me as a company, another is raising money from debt on which I'll have to compulsorily pay interest, which is risky. Despite ignoring the risk part, we say accept the offer. Third part, theoretical and like easy in nature, they say how much is the advantage benefit. So 18.3 minus 12 give me 6.3% per annum is the advantage. Sir, how do you know that we should not calculate the amount in absolute terms? No one can know. There is a possibility institute might have given to us the solution is 6.3% of the amount I need, which is 8.82 million. Then I calculate that in dollars as well, the amount of gain. Since they have kept it in percentage, we have also kept it in percentage. That is an easy question number 92. So in this video, everyone in the class, we have discussed the entire international financial management with the needed questions, needed practical questions in fact. Yes, boss? Yes. So all the topics with all the clarity discussed the initial few minutes, initial 40 minutes something, we talked about the forex. All needed questions done, right? As I said, whatever has been your genuine feedbacks, kindly comment down. And let me tell you, there are other far more comprehensive and interesting great videos on the chapters of AFM which you all must go through. Yes? So that was all from my side, everyone. Thank you so much for watching up this video. All the very best for your exams. Let's meet back again in the next video. Bye. See you all. Take care, guys. Bye. See you all.